Welcome back to Investing Talk Podcast. Today we're tackling a question that seems to be on a lot of minds. Is Rocket Companies a good time to buy right now? The big name in mortgages. So our goal here is really to cut through some of the noise. We've waded through a pile of financial analyses, analyst reports, all focused on Rocket. And we want to pull out the key takeaways, give you a clear, unbiased look at where they stand and maybe where they're headed, basically help you understand what really matters in all this data. And hey, if you find this helpful, please do remember to subscribe, maybe give us a like, leave a comment. We genuinely love hearing from you.
Yeah.
Also, if you want us to look into a specific company next time, just pop it in the comment below. And maybe consider buying us a coffee if you feel like it. Links are below. Okay, so let's dive in. Rocket Companies. I mean, most people know them as the biggest U.S. retail mortgage lender, right?
That's right. They're huge in that space. Definitely number one in retail.
But they're actually a bit broader than that, aren't they?
Yeah, they position themselves as more of a fintech platform now. It's vertically integrated.
So it includes things like Rocket Mortgage, obviously, but also Rocket Homes, Rocket Loans.
Exactly. It's a sort of ecosystem covering different parts of the home buying and financing process. They've diversified, at least within that broader theme.
Okay, makes sense. So let's get straight to the numbers then, because that usually tells a story. What are the recent financials looking like?
Well, looking at the sources, their trailing 12-month revenue is sitting at about $5.15 billion.
All right.
And more recently, for their Q2 2025 earnings report, the adjusted figures were $1.34 billion in adjusted revenue. They reported $75 million in adjusted net income and adjusted EBITDA of $172 million.
Adjusted figures.
These
Those often look, well, reasonably positive on the surface.
Yeah,
Right? Gives that sense of positive momentum.
They do, and that's precisely where you need to dig a bit deeper. Because while those adjusted numbers, seem okay, the picture shifts quite a bit when you look at the GAAP net income for that same trailing 12-month period.
The GAAP numbers. Generally accepted accounting principles.
Exactly, and on that basis, it's actually negative, minus $308,000.
Minus. So basically zero or slightly less.
Pretty much. And their earnings per share, the EPS based on GAAP, is effectively break even at minus 1 cent.
So explain that difference again for listeners. Why focus on GAAP if the adjusted looks better?
Well, GAAP gives you that sort of unvarnished picture. It follows strict accounting rules without certain management adjustments for things like one-off costs or non-cash expenses. So when GAAP income is negative, it suggests the core underlying operations, by standard rules, aren't actually generating a profit.
Got it. So the adjusted numbers might paint a rosier picture, but the GAAP tells a tougher story.
Precisely. And negative GAAP income points towards, potentially very slim or even negative real profitability. That means less financial flexibility, maybe more volatility in their cash flow. It's a potential red flag.
Hey, that's a really crucial distinction. It does feel like two different stories depending on which numbers you look at. But here's the twist. Despite that weak GAAP profitability you just described, the company pays a dividend.
Yeah.
A dividend. 0.80 cents per share, which works out to a 4.32% yield right now. That seems, well, pretty high, especially compared to peers.
It does seem high, yeah.
So for someone focused on income, how do you square that? A high yield, but basically negative GAAP profits.
Is that sustainable? Is it a trap?
That is an excellent question, and it's exactly what income investors need to be asking here. Look, a high dividend yield is tempting, right? It looks like a great cash return on your investment.
Sure.
But sustainability is everything.
Yeah.
If the company isn't generating solid underlying GAAP profits, where's that dividend cash really coming from long term?
Right. It has to come from somewhere.
Exactly. Think about it personally. If you spend more than you earn consistently, how long can you keep handing out money? Now, Rocket has a big market cap, $39 billion, but look at its forward PE ratio, price to earnings.
Okay.
It's sitting way up at 45.66.
45. Wow. Yeah. And remember, the PE tells you what investors are willing to pay for each dollar of expected future earnings. A forward PE that high, especially with current GAAP earnings being negative, well, it suggests the market is baking in a lot of future earnings growth.
So the price is assuming a big turnaround that hasn't quite shown up in the core profit numbers yet.
That's a good way to put it. The market seems very optimistic. But if those underlying profits don't materialize to support that dividend, then its sustainability comes into serious question. That high yield might not be as safe as it looks.
Okay, so this tension is key. Adjusted numbers look okay. GAAP profits are weak. The dividend looks juicy but maybe questionable, which naturally leads us to valuation. What is Rocket actually worth right now according to the analysis? Is it expensive Or maybe is there a hidden bargain despite these concerns?
Well, if we zoom out and look at the valuation from a fundamental perspective, the consensus from the source material is pretty clear. The stock looks expensive.
Jensen, okay.
Yeah. I mean, you can't even calculate a normal PE ratio because the trailing earnings were negative, as we said. But that forward PE is, again, a very high 45.66.
And what about other metrics, like price to sales?
Good question. Their price to sales ratio looks like stock around $18.50 revenue per share, about $2.45. That puts it around 7.5 times sales.
And how does that stack up?
That's considered quite elevated for the mortgage services sector. In fact, pretty much all the standard valuation ratios, you look at price sales, price book, that forward PE, they're all substantially higher than the average for their sector, and also higher than the broader S&P 500 averages.
So the market's giving it a premium price tag compared to its peers in the market generally.
Exactly. It's being priced more like a high-growth tech stock, but the current earnings and the nature of the mortgage business don't fully align with that kind of premium right now.
That's really fascinating. So the market's clearly optimistic, pricing in a lot of future success. Which brings us to the crucial question. What do the professional analysts think? The folks who spend all day crunching these numbers, are they buying into that optimism? Or are they seeing something different?
Yeah, this is where it gets quite telling. The analyst consensus targets paint a very different picture from the current stock price.
Oh, how so?
Well, their price targets range from a low of $10.50 up to a high of $18.
Okay, $18 is near where it's trading now.
Right, but the average consensus target is around $14.65.
$14.65. So that's quite a bit lower than the current price, around $18.50.
It is. That average represents about a 20% potential downside from current levels. That's significant.
A 20% downside according to the average analyst. Wow.
Yeah. And while the sources we looked at don't give us a detailed discounted cash flow model to get an intrinsic value calculation, the overall analyst view, combined with that super high forward PE, strongly suggests the stock just isn't seen as attractively valued for someone looking to buy in right now.
So a real disconnect between the market price and where the analysts think it should be.
Definitely. It highlights that the market's current enthusiasm isn't really shared by the majority of analysts covering the stock.
Okay, that definitely argues for caution. So moving away from the pure fundamentals and analyst views for a moment, how has the stock actually been behaving in the market? What's the price action telling us? And what's the general vibe or sentiment? We know the recent price range has been kind of tight, like $18.51 to $19.12.
That's right. Recently, it's been in a narrow band.
But the 52-week range was much wider, wasn't it? Like $10 up to over $21?
Exactly. It went from a low of $10.06 to a high of $21.38 over the past year.
So where does it sit now within that range?
And this is what's quite striking. It's currently trading near the upper end of that 52-week range.
Near the highs, even though analysts are suggesting significant downside.
Precisely. It shows that disconnect again. The market price is holding up near the highs while analyst targets are pointing much lower.
What about volatility? Is it a steady stock or does it jump around?
Oh, it definitely jumps around. The stock has a beta of 2.29.
Okay, beta 2.29. Remind us what that means in simple terms.
Sure. Beta measures how much a stock moves compared to the overall market. A beta of 1 means it moves in line with the market. A beta over 1 means it's more volatile. So 2.29 means Rocket tends to have moves that are more than twice as large as the broader market's moves.
So amplified ups and amplified downs.
Exactly. If the market dips 1%, Rocket could potentially dip 2.29%. It's a significantly more volatile investment than the average stock.
Okay, good to know. And what's the recent technical trend been like? Up, down, sideways?
The sources describe the recent trend as neutral to weak. And analysts are generally forecasting sort of sideways or maybe even modestly negative price action from here, not expecting a big breakout upwards.
So high volatility, trading near its highs despite analyst warnings, and a weakish trend.
Interesting mix.
Did that recent Q2 earnings report, the one with the mixed results, adjusted profit but negative gap, did that change anything? Did it shift sentiment among analysts or the market? Did it move the needle?
That's the key question, right? Did it change the story? And the sources suggest not really. While the adjusted net income was positive, that persistent weakness in the gap profitability was still the main takeaway for many.
So no rush to upgrade the stock based on that report?
Apparently not. If you look at the breakdown of analyst ratings, it's pretty clear. Out of 13 analysts covering it, the consensus is overwhelmingly hold or reduce.
How many buys?
Only 1 buy rating. Then you have 2 sell ratings, and a big chunk, 9 analysts are sitting on hold.
9 holds. That signals a real lack of conviction for upside, doesn't it?
It does. It suggests most analysts are saying wait and see, or maybe avoid for now.
And what about, like, social media buzz, retail investor interest?
The reports describe social media and general news sentiment around Rocket as pretty neutral. There's no strong retail momentum or hype building up that you sometimes see pushing a stock higher. It seems like a lot of the market is just watching.
Okay, so we've looked at the numbers, the valuation debate, the market action. It paints a fairly consistent picture, actually. But investing is always forward-looking. So what are the big risks here? If you're considering Rocket, what should you be worried about? And conversely, are there any potential catalysts that could actually change this narrative and give the stock a boost?
Right, looking ahead. A primary risk, and this is really specific to Rocket's core business, is its extreme sensitivity to interest rates.
We talked about that connection.
Their whole model revolves around mortgage originations and refinancing. When interest rates go up,
Fewer mortgages, less refinancing.
exactly, demand just dries up, hitting their revenue directly. It's not a side issue, it's fundamental to their business health.
Okay, so interest rate risk is number one. What else?
Well, those ongoing profitability concerns we discussed, the weak or negative gap income that remains a big question mark. And importantly, the sources we reviewed noted there's not much evidence of a strong, durable, competitive moat.
A moat.
Hmm.
Like a sustainable advantage.
Yeah, something that protects their profits from competitors long term. The fintech and digital mortgage space is really crowded.
Lots of players.
Very crowded. And the barriers to entry for some digital services aren't that high. So it's tough for Rocket to really carve out a unique, protected space and maintain strong pricing power.
Makes sense. And broader market risks.
Definitely. They're exposed to the cycles of the real estate market itself. If the housing market slows down, that hurts them. Regulatory changes in lending could impact them, general macroeconomic shifts, recessions, and of course, because of that high beta we mentioned, any broader market downturn could hit Rocket harder than average. Lots of layers of risk.
Okay, that's a fairly sobering list of risks. But what about the flip side? Are there potential catalysts? Things that could actually push the stock up, short-term or long-term?
Absolutely, there are always potential catalysts. Short term, the very next earnings report expected around July 31st, 2025, could cause a stir, especially if they surprise on the upside, maybe show better than expected margins, meaning they're becoming more profitable. That could spark a short-term rally.
Okay, earnings surprises. What about longer term?
Longer term, the biggest factor, without a doubt, is interest rates and Fed policy.
The reverse of the risk.
Exactly. If the Fed starts cutting rates significantly, that could be a huge tailwind. It could reignite the refinancing market and boost mortgage demand generally.
That makes sense. Anything else?
Yeah, potentially shifts in the real estate cycle itself if the housing market really picks up steam again. Also, if Rocket manages to successfully expand and grow its other fintech offerings, like if Rocket Homes or Rocket Loans really took off and became significant revenue contributors, that could diversify their business away from just mortgage volumes.
So success in those other areas could make them less vulnerable?
Potentially, yes. And finally, maybe some future regulatory changes that could happen to favor large established players like them. So there are paths to upside, but they hinge on some major factors changing.
Okay, so putting it all together then, if we had to summarize the investment view from the sources we looked at, what's the verdict on Rocket companies right now?
The overall investment thesis rating coming from the analysis is pretty lukewarm. It's rated a 4 out of 10.
4 out of 10, so below average.
Definitely leaning negative. The key reasons are that high valuation relative to peers and its own fundamentals. That optimistic forward PE just isn't well supported by the current earnings or realistic near-term growth prospects.
And the analysts agree.
Yeah, the analyst consensus is clearly negative to neutral. Forecasts point to downside potential, and hold or reduce ratings dominate.
What about the dividend? Does that help?
It offers some support, sure, but the analysis suggests it might not be enough to offset the downside risk if the stock price does fall back towards those lower analyst targets, especially with those questions around JAP profitability and dividend sustainability.
Yeah, the tactics.
Weak to neutral, as we discussed. No strong momentum signals.
So the bottom line.
The bottom line from these sources is that Rocket Companies isn't considered particularly attractive right now. Not for short-term trading, given the weak trend and analyst views, and not really for long-term investment either, because of the earnings pressure, the high valuation, and those significant cyclical risks tied to housing and interest rates.
Wow, okay. A pretty clear picture emerges when you put all those pieces together.
It really is insightful, isn't it? how you take profitability, valuation, market sentiment, risk factors, and they all weave together. Understanding these different dynamics helps you critically evaluate the story around any company, whether you're actually thinking of investing or just want to understand what's happening in the financial world.
It definitely forces you to look beyond just the headlines or maybe just one metric like that dividend yield.
Exactly. You need the whole picture.
So here's something for you, our listeners, to think about after hearing all this analysis. How can companies like Rocket, companies that are so deeply tied to these big economic cycles like interest rates and the housing market, how can they genuinely innovate their business models to become less vulnerable, to find maybe more stable, more predictable growth even when rates are high or the housing market cools? What would that actually look like? Something to mull over. Well, thank you for joining us for this look into Rocket companies. We really hope you found these insights valuable.